Boston Scientific just absolutely crushed their second quarter 2026 internal guidance. Top line, bottom line. I mean, it is a clean beat across the board.
Yeah, really phenomenal quarter for them.
It really was. So Q2 reported net sales came in at $5.442 billion. That is a 7.5% reported increase year over year, which, steps right over their projected 5.5 to 7.5% range.
Right.
And adjusted earnings per share hit 86 cents, cleanly beating the 82 to 84 cent guidance, with GAAP EPS coming in at 61 cents.
And, well, you saw how the market reacted, right? The stock caught an immediate, just aggressive bid right on the open.
Totally. And looking forward, management is basically keeping the pedal down. For Q3, organic sales growth is projected at 3.0 to 5.0%, with adjusted EPS of 80 to 82 cents.
Which is solid.
Exactly. And for the full year 2026, they actually tightened their organic net sales growth expectations to a solid 5.0 to 6.0%, and they guided full-year adjusted EPS up to a range of $3.28 to $3.32.
So those headline numbers, I mean, they absolutely confirm the execution is there. But, when a medical device giant prints over $5.4 billion in just 90 days, a top-line beat is really only the outermost layer of the story.
Exactly. And that is basically our mission for this deep dive. We're unpacking the actual mechanics behind this beat for you today.
Right, because we need to see what's under the hood.
Yeah, we need to dissect the segment performance, see what is actually driving this growth. Plus, we have to scrutinize management's aggressive capital allocation, including this massive $1.5 billion strategic bet, and shine a harsh light on a very specific hidden risk that's kind of swelling on their balance sheet.
Yeah, there's a lot to dig into.
So let's get right into it. The revenue looks great, but where did that $5.4 billion actually come from, and how much of it actually fell to the bottom line?
Well, to understand the mechanics of Boston Scientific right now, you really have to look at the structural divide in their business, because they basically operate on two completely distinct cylinders. Cardiovascular is the undeniable behemoth, right? It represents 67% of total sales, and it brought in $3.62 billion just this quarter.
Oh, wow. So it's massive.
Exactly. And then the remaining 33% comes from their MedSurg division, which generated $1.82 billion.
So I'm looking at the numbers inside that massive cardiovascular engine, and the standout performer is interventional cardiology, which posted this staggering 15% organic growth rate.
Yeah, 15% is huge for that segment.
Right, and management specifically called out exceptional strength in their agent drug-coated balloon, or DCB.
Yep, the agent DCB is a major driver right now.
But okay, let's unpack this for a second, because the cardiovascular segment, well, it isn't just one monolithic growth engine, right? We can't just cheer the 15% number without looking at the whole picture.
Right, you have to look at the offsets.
Exactly. Because if interventional cardiology is booming at 15%, why is cardiac rhythm management, their CRM business, actually shrinking by 2% year over year?
Well, that is the reality of managing a massive legacy portfolio. You are looking at two products that are essentially at opposite ends of their life cycles.
Makes sense.
So cardiac rhythm management primarily consists of things like pacemakers and implantable defibrillators. And that is a highly mature, heavily penetrated market.
Right. Everyone who needs a pacemaker basically has one.
Exactly. The innovation curves have just flattened out there.
Yeah.
And growth is incredibly hard to manufacture. It is essentially a replacement market at this point. But on the other end of the spectrum, you have interventional cardiology.
And that is where the agent drug-coated balloon lives. So can you explain mechanically why hospitals are adopting this thing so fast? Like, what does it actually do?
Yeah, so it is a brilliant piece of engineering, honestly. Historically, if you had a blocked coronary artery, a surgeon would go in, inflate a standard balloon to open the vessel, and then they'd leave a permanent metal stent behind to keep it open.
Okay, standard procedure.
Right. But sometimes scar tissue builds up inside that metal stent over time, and it reblocks the artery, which is a condition called restenosis.
Oh, wow. So the fix actually causes another problem.
Exactly. And the agent drug-coated balloon completely changes that game. The surgeon goes in, inflates the balloon to open the blockage, and the surface of the balloon actually transfers a specialized anti-restenotic drug directly into the artery wall.
Wait, really? Just from the surface of the balloon?
Yep. And then they deflate the balloon and take it right out. No new metal is left behind in the patient at all, but the medicine stays there to prevent those future blockages.
That's incredible.
It is. It is a highly premium specialized tool, and physicians are just adopting it rapidly because frankly, the clinical outcomes are fantastic.
Well, that definitely explains the 15% surge. But I do have another bone to pick with this cardiovascular segment.
Is that
Well, historically, Watchman, which is their device for closing the left atrial appendage in the heart, that has been their absolute golden boost for growth. But this quarter, Watchman only grew 4% organically.
Yeah, that 4% number definitely stood out.
I mean, a 4% print for a historical high flyer, that feels like a red flag to me.
It is definitely a deceleration, yeah.
Yeah.
And it's largely driven by market saturation and, frankly, new competitive entrants in that appendage closure space. But here is the critical offset that saved the segment.
Okay, what is it?
Electrophysiology, or EP. While CRM contracted by 2% and Watchman slowed down to 4%, their electrophysiology business stepped right up with 9% organic growth.
Oh, I see.
Yeah, they effectively used the momentum in their EP and interventional cardiology divisions to just bail out the cardiovascular segment's overall average.
And that balancing act, I mean, that directly impacts the margin story. CEO Mike Mahoney specifically pointed out that the team delivered these results while navigating a, quote, dynamic environment, which, let's be honest, is just CEO speak for global supply chain friction and inflation.
Oh, absolutely, 100%.
Yet, despite those macro headwinds, adjusted gross margins expanded 80 basis points year over year to 70.3%, and adjusted operating margins climbed 70 basis points to 28.4%.
And what's really fascinating here is the underlying math of that margin expansion. When a company doing billions in sales sees growth margins cross that 70% threshold and then expand by 80 basis points on top of that,
Yeah.
you're witnessing the sheer power of product mix.
Okay, break that down for me.
Well, they aren't necessarily manufacturing things cheaper. Instead, they are just disproportionately selling their most profitable proprietary technologies like that agent balloon and their new electrophysiology catheters.
I get it. While the lower margin mature products,
Like the pacemakers.
right, they become a smaller piece of the total revenue pie.
Exactly. It is a textbook example of leveraging organic innovation into bottom-line profitability.
So what does this all mean for the cash flow then? Because expanding margins on $5.4 billion in sales creates a massive, massive amount of liquidity.
Oh, it's a cash machine right now.
Seriously, this quarter alone, Boston Scientific generated $1.29 billion in free cash flow, over $1 billion of free cash in just 90 days. And they definitely put that capital to work.
They attack capital allocation very aggressively, yeah.
Yeah.
And it started with returning capital directly to the shareholders.
Right. They completed this $2 billion accelerated share repurchase program, retiring about 40 million shares from the open market.
Which is pretty standard financial engineering.
True, but it signals massive confidence in their own valuation. But to me, the share buyback isn't actually the most interesting way they deployed capital this quarter.
No, it's definitely not.
Here's where it gets really interesting. It's the $1.5 billion investment in Mirus LLC.
Yeah, this is huge.
Because this isn't a traditional acquisition. For $1.5 billion, Boston Scientific is taking a 34% equity stake. But crucially, they're securing an exclusive option to acquire the Mirus TVR business down the line. Specifically, the Seagull Balloon Expandable System.
If we connect this to the bigger picture, this is a highly calculated maneuver to address a glaring hole in their portfolio.
Because of TAVR.
Exactly. TAVR stands for transcatheter aortic valve replacement. For decades, if a patient had a failing aortic valve, it basically meant open heart surgery. They had to crack your chest open.
Right, a massive, invasive procedure.
But TAVR allows physicians to replace that valve by just threading a catheter up through an artery in your leg. It is a massive multi-billion-dollar market, and it's growing at high single digits.
And Boston Scientific hasn't really been in it?
Historically, no. They have been largely locked out of it by deeply entrenched competitors.
So they needed a way in, but they clearly didn't want to buy the whole farm just yet. I kind of look at this $1.5 billion move like a highly strategic call option.
Yeah, that's a good way to look at it.
Or really, it's like paying for the right to buy a winning lottery ticket, but only after you see the winning numbers get drawn.
That is an excellent way to frame it, because Mirus is developing some incredibly advanced proprietary biomaterials for these replacement valves. But clinical trials in the structural heart space are notoriously risky and incredibly expensive.
Right, things can go wrong fast.
Exactly. So by taking a minority stake with an exclusive purchase option, Boston Scientific essentially de-risks the clinical side of the equation.
Oh, that makes sense.
If the Seagull valve proves itself in the ongoing STAR clinical trial, Boston Scientific has locked down their right to buy it and integrate it into their massive global distribution network.
And if it fails?
If the trial fails, they are only out their initial equity investment. They don't absorb the devastating blow of a full-scale acquisition gone wrong. They are securing proprietary technology to eventually go head-to-head with the biggest players in structural heart, all while capping their downside risk.
It is just brilliant corporate maneuvering. I mean, you lock up the asset so your competitors can't touch it, but you don't absorb the full weight of the company until the clinical data is practically a sure thing.
Exactly.
But Mirus is a safety net for the future. To justify a $5.4 billion quarter today, their current pipeline has to be delivering real-world results.
And it is.
Well, did the recent cardiology conferences actually validate these premium valuations? Because I saw their avant-garde study was making massive waves at the Heart Rhythm 2026 conference, but I need you to translate the medical data for me.
Sure.
What makes their FARAPulse pulsed field ablation, or PFA, system so special?
Well, to understand why FARAPulse is causing such a stir, you really have to understand the traditional standard of care for treating atrial fibrillation, or AFib.
Okay.
Historically, if a patient had an irregular heartbeat, surgeons would perform an ablation. They would snake a catheter into the heart and use extreme heat, so radiofrequency or extreme cold cryoablation, to intentionally scar the heart tissue that was causing those erratic electrical signals.
Okay, that sounds intense.
It is. And the problem is that extreme heat and extreme cold aren't very precise. You run a very real risk of collateral damage.
Like what?
Like burning the esophagus or damaging the phrenic nerve, which are located right next to the heart.
Oh, wow. That sounds terrifying for the patient. So how does pulse field ablation actually change that dynamic?
PFA represents a complete paradigm shift. Instead of thermal energy, PFA uses incredibly fast, non-thermal electric fields.
Okay.
And what makes it revolutionary is that heart muscle cells actually have a lower threshold for these specific electrical fields than the surrounding tissues do.
Oh, I see.
So the device selectively zaps and destroys only the targeted heart tissue causing the arrhythmia without damaging the esophagus or the nerves nearby.
So it's literally destroying the specific cells causing the problem without burning everything around it.
Exactly.
Well, no wonder the data was so strong. I mean, the avant-garde study showed that FARAPulse achieves statistical superiority over traditional antiarrhythmic drugs.
Right.
And when a device proves it is mathematically superior to a pharmaceutical intervention for a complex condition like AFib, I mean, that changes the fundamental treatment algorithm for physicians.
Oh, completely. And they backed that up with the Elevate PF feasibility study, which looked at their FARAFlex mapping and PFA catheter.
What did they find there?
They demonstrated strong lesion durability, but honestly, the real showstopper was the safety profile.
Really?
Yeah. They reported 0 cases of pulmonary vein stenosis, which is a dangerous narrowing of the veins. They had 0 hemolysis, meaning the device wasn't destroying the patient's red blood cells,
Wow.
and 0 coronary spasm and 0 clinical stroke.
That's practically unheard of. And outside of electrophysiology, they also dropped impressive data at EuroPCR for their SeismicQ 4CE coronary intravascular lithotripsy catheter.
Right, the fracture trial.
Exactly. The fracture trial met its primary endpoints for treating severely calcified coronary artery disease. And just to be clear for everyone listening, lithotripsy in the heart works similarly to how they treat kidney stones, right?
Precisely. If a patient has severe calcium buildup in a coronary artery, a standard balloon might just rupture the artery if you try to force it open.
Right.
So lithotripsy uses localized sonic pressure waves to safely crack and fracture that calcium buildup from the inside out, which allows the surgeon to safely open the vessel.
And they saw good results.
Yes, proving high rates of freedom from major adverse cardiac events at 30 days in the fracture trial is just a massive win for their interventional tool belt.
But looking at this rapid succession of clinical wins, the FARAPulse PFA, the FARAFlex mapping catheter, and with the pivotal Paradigm clinical trial already commencing enrollment, it kind of feels like an aggressive land grab.
It absolutely is.
Are they just trying to build like an Apple ecosystem for the operating room?
That is exactly the strategy, and it is highly effective. They are building a defensive moat around complex arrhythmias.
So?
By integrating the diagnostic mapping phase and the therapeutic ablation phase into a single, seamless workflow with superior clinical outcomes and a pristine safety profile.
Which locks hospitals in.
Exactly. The switching costs for a hospital become enormous. Once a surgical team is trained on the Ferroflex mapping system and the Ferropulse ablation tools, they aren't going to try to piece together a competitor's diagnostic catheter with another company's ablation tool.
Right. Why would they?
Exactly. If you own the mapping and the ablation, you own the entire operating room for that procedure.
The clinical momentum is undeniable, for sure. But, it is our job to look at the whole picture, and it wasn't a flawless quarter. We need to look at the MedSurg segment and, more importantly, some troubling data on the balance sheet.
Yeah, let's get into the soft spots.
So let's start with MedSurg. The clear soft spot this quarter was urology. Global net sales for urology only grew 1.1% on a reported basis.
Yeah, that's noticeably weak.
Right. When the rest of the company is posting 7, 8, even 15% organic growth, a 1% print is a glaring anomaly. Management blamed a slower than anticipated recovery in their sacral neuromodulation business.
And for those unfamiliar, sacral neuromodulation is essentially a pacemaker for the bladder or bowel. It uses electrical impulses to correct overactive bladders or incontinence.
Okay.
It is a vital therapy, but the market recovery there has just been sluggish for Boston Scientific.
And they also admitted to ongoing competitive pressures and key, quote, portfolio gaps in their Stone franchise.
That's pretty telling.
Right. When a management team openly admits to a portfolio gap, that means they literally do not have the specific tools needed to fight back effectively against competitors in that niche.
Exactly.
But while a sluggish urology segment is basically a contained operational issue, there is a metric on the balance sheet that warrants intense scrutiny, and that's the working capital data.
Yes, specifically the inventory metrics.
Break that down for us.
Well, days sales outstanding, or DSO, held steady at 51 days, which means hospitals are paying their bills on time. No issues there. But days inventory on hand, or DIOH, crept up significantly.
Yeah.
In June of 2025, so a year ago, they held 159 days of inventory. This quarter, that number jumped to 185 days.
Wait, let's look at the actual math on that. That is a 26-day increase in inventory holding time over the last 12 months.
Yep.
For a company doing over $5 billion in quarterly sales, holding nearly half a year's worth of inventory ties up a massive amount of capital. Are you seriously telling me they are doing this on purpose as some sort of strategic buffer? Or is this a massive red flag that their gear just isn't selling as fast as it used to?
Well, this raises an important question for you to consider as you evaluate the health of this company. In the medical device industry, expanding inventory cycles can be interpreted in two completely divergent ways.
Okay, what's the bullish case?
The bullish case is that this 26-day jump is a purely defensive strategic buffer. Remember the dynamic environment the CEO mentioned?
Right, the supply chain issues.
Exactly. It is highly plausible that management is intentionally stockpiling raw materials, microchips, and finished medical-grade components to just insulate themselves against global supply chain shocks. If that is true, leveraging their massive free cash flow to ensure they never stock out of a life-saving device is brilliant management.
I'm not entirely buying that excuse, honestly.
Why not?
Because the alternative scenario is that it is a leading indicator of a fundamental slowdown in certain segments. If products in underperforming divisions, like that urology segment we just discussed, are sitting in warehouses longer than internal models predicted, the aggregate inventory days will mechanically rise.
And that is the bearish risk. While the top-line beat today is fantastic, a bloated inventory channel acts like a ticking clock on margins.
Because they have to move it eventually.
Right. If that inventory gets too old, they eventually like to discount it to move it. Or worse, they have to slow down their manufacturing plants to let sales catch up with supply.
Which hurts the bottom line.
It crushes their fixed cost absorption and directly hits operating margins.
And that is exactly why we look past the headline EPS beat. A 185-day inventory cycle is definitely a tension point you need to track in Q3 and Q4.
Absolutely.
We need to see if that metric normalizes or if it continues to swell and starts eating into that beautiful 70% gross margin we talked about earlier.
It is the single most compelling contradiction in an otherwise stellar earnings report.
Yeah.
I mean, you have a company successfully expanding operating margins and generating over $1 billion in free cash. Yet their supply chain is holding almost a month more inventory than it was a year ago. It absolutely requires close monitoring.
So bringing all of this together, the 15% explosive growth in interventional cardiology, the aggressive $1.5 billion TAVR option with Maris, the clinical superiority they just demonstrated in pulsed field ablation, and then, the sluggishness in their legacy MedSurg and urology businesses. When you synthesize all of that, what is the big takeaway for the listener?
Well, if you look at the trajectory of their capital allocation and their clinical pipeline, it leaves you with a really fascinating macro thought to mull over. With the Mirus TVR option secured, they've locked in a future, de-risked path into the massive structural heart market. And with the Farapulse system gaining undeniable clinical dominance in electrophysiology, you really have to wonder about the long-term identity of this company.
What do you mean?
Will Boston Scientific's aggressive, highly successful cardiovascular innovations eventually completely overshadow and outgrow their legacy med-surg businesses? Are we actually watching the slow, deliberate transformation of Boston Scientific into a pure-play cardiovascular juggernaut by the end of the decade?
You know, it certainly looks like the cardiovascular engine is pulling the entire train right now, and they are allocating their capital to ensure it stays that way.
It definitely seems that way.
And that wraps up our deep dive into the Q2 2026 earnings. Be sure to follow the show for your daily dose of earnings coverage as we continue to break down the biggest reports of the season.